Today, we're going to look at how a total return strategy can potentially save a lot more in taxes relative to a purely income-based strategy. And we're going to look at two different scenarios for a household that's needing to regenerate about $10,000 of cash flow to recreate their needed expenses in retirement. So in this first scenario, for an income chasing scenario, they've bought a bunch of high yield bond instruments that produce $40,000 in the year. And then they also got $40,000 worth of dividends from high dividend stocks. And then they have a $40,000 annuity or pension to get the remainder of their income. So a total of 120,000 of income. And then we're going to contrast that with scenario two, which is a total return strategy, which is a combination of interest, dividends, and capital appreciation. So this, right, the taxable interest is 16,000, the total dividends a bit lower at 30,000, and then the remainder of their cash flow is created from selling investments such as stocks or real estate that have appreciated in value and have been held at least a year. And that's where the additional $74,000 is coming from, what's called long-term capital gains. So if we look at the total quote unquote income or cash flow on the tax return, it's 120,000 in each scenario. Let's assume that both of them are taking the standard deduction of approximately 32,000, so that reduces their taxable income in both scenarios a bit. So their taxable income is the exact same, but then when we come and look at what the actual total federal taxes is for each scenario, the total return dynamic withdrawal strategy results in $0 or a 0% tax rate, whereas the income chasing strategy, the taxes needed to be paid from somewhere in the portfolio, creating what's called tax drag, is just over $6,400 a year. Now, the effective rate isn't drastically high in this scenario, only 7.3%. But again, relative to a total return strategy that's more dynamic of how you're recreating your needed cash flow in retirement, the total return dynamic strategy is a lot more tax efficient that will add up over extended time periods as you think about this, the compounding effects of this year over year.